Welcome, everyone, to another episode of the YouTube show and podcast, None of Our Businesses. I'm Ty Carr, and with me today is Charlie Zygmunt.
Thanks for joining.
And we're two accountants talking about the week's news and business, tax, well, anything really, all from the perspective of accountants. Two accountants this time. Jack DiMattio's out this week, but we'll be back to three at some point. In the meantime, here's what we have for you. Hamsters picking stocks. A charitable contribution reminder. Hey, if you've got money to spend, IRS says here's where you should spend it. The debt ceiling problem. Can it be solved with a $1 trillion coin? And finally, the IRS is not allowed to use enforcement actions to rank its agents. All right, well, let's get started off with hamsters picking stocks. Charlie, take it away.
All right, so I've got an article we can talk about from npr.org. It's called "A Crypto Trading Hamster Performs Better Than Warren Buffett and the S&P 500." And so, the article just talks about there's this hamster that a tech person has been, basically what's happened is that they've built this enclosure for a hamster. His name is Mr. Gox, named after Mt. Gox, the cryptocurrency trading platform. And what happens is that the hamster is able to choose which path. He has two tubes inside of his cage, and he's able to choose which tube he goes to. And they use the results of where he chooses to go to decide how to buy cryptocurrency. And that drives, and they basically have a system set up that has automated everything outside of what the hamster does. And so and they're basically saying that according to his Twitter, so you do have to kind of take it with a grain of salt, but according to that, his portfolio is up nearly 20% since June. He's performing better than Bitcoin, the NASDAQ 100, and Warren Buffett's Berkshire Hathaway stock. And so it's random, obviously, what the hamster chooses to do. And so this can come off as kind of silly, but I guess there seems to be a bit of mystique to how people go about choosing their different stock picks. And I think there's a lot of creative ways that you can go about that. And I think there's kind of something to be said for the fact that even the most educated of guesses sometimes come up short to what a random hamster might choose. And so I just kind of wanted to open that up for discussion and see what you thought about that. See if there's anything more to it than that.
Yeah, I think it's again, another variation on the dartboard concept, right? That, you throwing darts at the board and letting that pick your stocks might be just as much, just to do just as much or more than professional advisors can do stock picks. I think, they do these kind of anecdotal research studies every once in a while to kind of make this point that it's very, very difficult for a professional advisor to outdo the broad market or outdo index funds. And the implication being, why pay for professional advisors? Why pay, if you're in a mutual fund and you're paying fees for a stock picker, essentially, or if you're a high net worth person or have capital to invest and you're paying for an investment advisor to essentially be a stock picker, why exactly are you doing that? Because these kinds of these kinds of studies indicate that it doesn't have any particular value to it. I would suggest that the hamster's actions aren't necessarily random. They're just not necessarily correlated with, or there's no reason to think that they should be correlated with the stock market. but I don't know. In the universe of possible actions that occur, maybe there's vibes out there that hamsters are attuned to, and there is a correlation that we can't easily observe.
Yeah, you would think they'd at least use a groundhog or something. I mean, at least there's some kind of mystique to this. And the article talked about some other creative ideas that I thought were interesting too. Like there was a bot they wrote that would basically look at whatever Donald Trump would tweet, and then it would make its stock picks based on that. And then there was a couple of other ideas, but yeah, I just thought that was kind of interesting. But I know you've got another article we can talk about that's a little bit different of a way you could spend some money. What do you got?
Yeah, I mean, if we're going to talk about ways to use your discretionary income, throwing it into a fund for a hamster to pick, that would be one option. But another potential option the IRS reminds us of, I thought this was interesting that the IRS proactively was reminding taxpayers of this, but the IRS reminds us that we can get a deduction for making charitable contributions, and that in fact, the potential tax deduction, the potential tax benefit from that deduction is a little bit larger in some cases than normally under normal law. And that's because there was some increases to limitations which are available through 2021. So, one point of this topic is simply interesting that the IRS is spending time and effort to provide this kind of reminder. Hey, by the way, there's a tax deduction here, taxpayers you could be availing yourself of, like a community service type of thing. But then also kind of the technical details of what they're reminding of. I'll get into it a little bit here. One of the things that tax law since I've started has changed is the idea that if you don't itemize your deductions, you can still get a charitable deduction. So if you're an individual, you can still, in your married filing jointly, for example, you could still claim up to $600 as a deduction, even though you're not technically itemizing. So it's like a mini itemization. So that's kind of that's something to be aware of, is that if you think, most of us kind of in the old school tax world are like, well, don't even bother counting your charitable contributions if you're not otherwise itemizing your deductions, which may not matter. You might not be itemizing your deductions because you don't have enough home mortgage interest or other taxes, are usually the big ones, state taxes and home mortgage interest, that combined with charitable deductions that give you a benefit for itemizing under tax classic anyway. But in recent history, the way the tax law works is that even if you're not doing all of that, you might still get a benefit from charitable contributions through this, what I called mini itemization process. So talk to your, if you're not an accountant, talk to your accountant about that if you're an individual taxpayer. And then the other change here that is temporary is that your itemized deductions, or what I should say, sorry, your charitable deductions are usually limited based on your AGI. That is, you can't, under tax law classic, as I called it, you can't just wipe out your entire adjusted gross income. You can't wipe out your entire tax base by just giving it all to charity. There's a limitation. You can only deduct up to a certain percentage of your what they call adjusted gross income on your 1040 individual tax return. And it depends on the type of organization that you're donating to, but those limits under tax law classic would have run between 20% to 40% of your adjusted gross income. But right now through 2021, it is up. So you can actually, as an individual, you can actually wipe out your entire adjusted gross income. You can take a deduction. If you're itemizing, you can take a deduction for charitable contributions up to 100% of your adjusted gross income and basically wipe out your tax that way. So that's a interesting reminder that the IRS gives us. And then, we play, in terms of where I spend my time is more on the corporate side with corporations and partnerships and small businesses than with the individuals themselves. And so people may know that when you're a C corporation, you also are limited on the amount of charitable deduction you can take, similar to an individual, but it's not based on AGI. That limitation is based on the corporation's what they call taxable income, but it's a similar type of concept. And again, if I were to speak to tax law classic, that limitation is usually 10% of the corporation's taxable income. But similar to what I was talking about earlier for individuals, for a C corporation, that limit has been increased to 25% through the end of 2021. So those are just a few of the things that the IRS wanted to point out to us. And again, I think both pieces of it, just the actual meat of this, the ability to get more deduction is of interest, and also the policy point in terms of the IRS spending time and effort reminding taxpayers that they can actually take more deductions. That's an interesting point. Love to hear your take on either one of those or both, Charlie.
Yeah, I think it's really cool because it's kind of interesting. If you think about it conceptually, it's like the government's kind of giving you the ability to direct your tax dollars to maybe a cause that you would, believe in, or that you see as a good purpose. Your tax rate isn't 100 chance for you to really put your money into things that you believe and be able to do that a little more economically than you could in other years. And so I think it's an interesting opportunity, especially for people who have big political stances about what they think the government should or shouldn't do with their money. This is your chance to go ahead and put it where you think it should go. And so, we'll see how that plays out. But in general, I think it's a good thing. And I think it's at a time where anything that helps to kind of drive down the gap of wealth inequality, anything that makes it easier for giving to occur and that sort of a thing, I think is a good thing in this time and in this kind of state of the economy. So that would be my take on it.
Yeah, no, great points. And, talking about the state of the economy, we sometimes don't do ourselves any favor with the way we govern ourselves, and we're back at it with the debt ceiling again, right? So I think you have an article on that. Tell us what that's about.
Well, I'll be honest. I read the article and I'm not sure that I have anything that, I don't know that I can provide value here, but I'll tell you what I've read about. So there is an article in Seeking Alpha called Debt Ceiling Impasse. Can a $1 trillion coin solve it? And the idea here, as I understand it, and again, you have to take this with a big grain of salt, the House on Wednesday passed a bill to suspend the US debt ceiling. And so things are going crazy. Treasury Secretary Janet Yellen warned that on October 18th, the government's going to run out of money to meet its debt obligations to debt holders. And it set up a drama-filled atmosphere on Capitol Hill. Apparently, Congress has raised or suspended the ceiling 78 times since 1960, according to the Treasury. And the most recent time was in 2019. And there is some debate about whether the U.S. had ever defaulted in the past. Depends on how you define defaulting. The article lists some examples of times that the U.S. debatably defaulted on a debt. But I thought the interesting thing in the article, and the part that I'm kind of alluding to, is that there's an idea that a $1 trillion coin should be minted and added into the Treasury. It's a platinum coin. It's minted under commemorative clauses. They're going to deposit it at the Federal Reserve, and then the asset swap would result in an extra $1 trillion to cover a big portion of Washington's bills. Now, I'm quoting from the article here, of course. It says, while not illegal, the accounting gimmick would be unprecedented, threaten the checks and balances of Congress, and open a Pandora's box about all of public finance. And so to me, what was interesting about it is it just seemed like the most American of ideas that I've ever heard about how to fix the economy is like, well, can we just like put a big old fake number in here with a gold coin and see if that fixes it? And so I wanted to kind of get your take as a more educated person than I about what this really means, and practically speaking, how can I utilize this information? That's what I would say.
Oh, geez, that's a tall order. I don't know that I can speak to what it really means, but I mean, I do find it interesting. I mean, yeah, the idea that one branch of government can basically kind of, yeah. I mean, I think there is a broader context, which is probably different than what you might be thinking I was going to say. But the broader context would be here is that seems to be the theme of our politics today, is one branch of government figuring out how to circumvent the other branches of government, right? So I don't like that general idea, the idea that we're constantly looking like, how can we do an end run around the other branches of government? This one seems funny and creative and intriguing, but when you boil it down to that's the underlying intent of it, that part's kind of disturbing. So I'd say I'm not in favor of it from that standpoint. I have a different thought on it too, though, which is, we've talked about cryptocurrencies a lot on this podcast, and China's been cracking down on the use of cryptocurrencies within their borders, and I was thinking about this. It is kind of an old school way of doing the end run around to actually create a physical coin. I wonder, could they do the same thing by being willing to adopt cryptocurrency, and perhaps using it, they could do something similar in the digital realm, which if they're gonna, if they were so inclined, like I said, I don't support the end run around as a process, but if I were so inclined to do an end run around, I would say, why not go for the gold, so to speak, right? No pun intended. But why do it in such an old school way? Why not go all the way and see if we could do it do it by going digital with a cryptocurrency? So I would throw that into the creative pile of ways to circumvent the government.
No, I think that's true. If we're just going to make up money, why don't we go to these guys who've been making up money for, years now and see how they do it? No, that makes a lot of sense.
Exactly.
All right. So I think you had one more article we could talk about.
Yes. Yeah. So this one is interesting. It makes sense to me. I don't think I knew about this, but it's about tax administration. When I say tax administration in the accounting world, there is there's tax law, like understanding how do you compute your taxable income, how do you pay your tax, what your tax rates are, what's a deduction, what's not, what's taxable, what's not. That's all kind of the tax laws of how do we get of what's the tax base, what do we get taxed on, right? There's kind of a different topic in accounting that I would call tax, that I refer to as tax administration. When I say tax administration, I mean the process of the IRS collecting tax from us, and the process that we go through to work with the IRS to get that right, and potentially if it comes to that, challenge the IRS on their process. So in this realm of tax administration, there is such a thing as a tax inspector general. The inspector general's office in the government is an office across all departments of governments that is used to self-audit government departments, essentially, right? The inspector general is supposed to be independent of the government agencies they audit. And so there's different inspector generals for different government agencies across the spectrum. And so in the tax world, there is a tax inspector general for tax administration. Often it's abbreviated TIGTA, TIGTA. So the TIGTA is this inspector general. And so their job is to help audit the IRS, to see how does the IRS actually do their job, and are they doing their job in compliance with the law. And what they found is that the IRS is not following the rules exactly when it comes to how they evaluate their employees. And so what they're doing that is not in compliance with the law is that in some cases they have been evaluating employee performance based on what they call enforcement action goals or quotas. So in other words, the IRS is investigating or auditing taxpayers, and then as a result of these investigations or audits, they would have, in some cases, enforcement actions where they find that taxpayers haven't paid enough tax or did it late or whatever. And so then they charge penalties, or they require something from the taxpayers. They enforce something on a taxpayer. And so those enforcement actions become part of a record, right? And so it's been law. Apparently, I didn't know about this, but since it's part of Section 1204 of the IRS Restructuring Reform Act from back in 1998. So it's been law for quite a while now that the IRS cannot evaluate its employees. It cannot provide employees with quotas or goals on enforcement actions. It can't say, hey, you've got to rack up a certain number of penalties or other enforcement actions against taxpayers in order to be doing a good job. And yet, the inspector general of tax found that the IRS was doing exactly that. So 3 instances that they noted, or 3 types of instances, they noted 3 violations where enforcement actions were used against supervisory employees' performance evaluations. They found 1 violation where an enforcement action was used on a non-supervisory employee's performance evaluation. And then they found 1 violation where an employee's mid-year narrative, I guess that's kind of like a how are you doing, but not formally a performance evaluation. But in any case, on 1 employee's mid-year narrative, they included inappropriate language related to fraud referrals. In other words, I think the inspector general felt from looking at the at the mid-year narrative of that employee that they were being chastised or otherwise incentivized based on how many fraud referrals they had, which I guess is considered an enforcement action. So I would say, yeah, from my perspective, it's kind of good to know that the rules of the road for the IRS are not, hey, go rack up as many enforcement actions as you can. But it's also unfortunate to see that even though that's what the rules are, they kind of do that anyway. And at least that's what the Inspector General found. So yeah, I'll pass it over to you, Charlie. What do you think about this mess?
Yeah, I mean, it seems unfortunate that they have to codify that so clearly to say that can't happen that way. It's the same sentiment that is why we don't pay police officers according to the amount of years that that the people they work with get in prison, right? We don't have a pay structure for officers that works that way, because we know that the things that people do to get put into jail have nothing to do with the effectiveness of the police officer enforcing the law behind it. And so, it's just a case of you have to look at each scenario and ask yourself, what is causing this end result? Is it because the agent is good, or is it because the taxpayer is bad, or is it some combination of both? And, it's not as simple as a salesperson's commission in the case of selling basketballs or something that can be really heavily attributed to the individual versus some combination. So I think it's a good thing. I think it's good that there's a system in place to put these checks and balances. And, I'm glad that even the mid-year narratives that can be informal are documented well enough that something like this could come to light, because otherwise, who knows how, because you wouldn't even know. As a taxpayer, you just pay your taxes and you wouldn't even realize that some other enforcement was ultimately an incentive for some IRS agent. So yeah, those are my thoughts on it.
Yeah. And, as you were talking about this, something that occurred to me, a complexity in this from a holistic standpoint. A couple of weeks ago, I think you were out when we did that podcast, Charlie, but I did an article on the Biden administration's plan to increase the IRS funding, and how they forwardly said that the intent of increasing the funding and increasing staffing was to generate more tax revenues, to enforce more and get more compliance and get more tax revenues. And then the article I was actually looking at, if anybody wanted to go back and look at that prior podcast, was it was the Congressional Budget Office was analyzing this concept and was concluding that they agreed that they're, and they had some estimates of how much Treasury tax revenues would go up, based on the funding, the extra funding that'd be given the IRS. So there is an interesting paradox here in the sense that we're kind of very blanketly saying, well, if we increase the budget of the IRS to go out and enforce more, we're going to increase tax revenues. And politically right now, at least on one side, we say that's a good thing. But then on the flip side, we say, oh, but you can't actually use enforcement actions as an employee evaluation tool. So it's nuanced, right? I mean, it is kind of a complex thing that gets played with there.
Yeah, that's interesting. I would definitely have felt outrage at that first article for that same idea. It does seem like a weird, statement if you're looking at a system and you just go, can we pump more money into it so that we can take more from the people, and just for the sake of having taken more, it seems like the outcome that would be achieved of that action. So yeah, it seems very strange, and I'm glad that it's not happening so easily in all cases. That there's some pushback on it.
Yeah, well, and I think I said, in the last podcast, I said my concern was they'd pump all this money, but then they would really not necessarily hire people with the right amount of experience to really go after the right things. So they'd waste a lot of time being inefficient, going after the right things that would actually bring in more tax dollars. And I think this is a different spin on that point, right? It's like, well, we pump all this money, but then on the flip side, if we can't even measure, and we shouldn't, and we kind of agree, it makes sense that we probably shouldn't be measuring people that are evaluating people that way, then it's like, well, the effectiveness of pumping money into that is somewhat limited because it's somewhat contrary to public policy, kind of as you're saying. So, yeah, I think that is the inherent problem. I'm very supportive of enforcement in general as a tax professional because I've always said, it kind of makes my knowledge base and my profession of limited use if we're not all having to follow the rules anyway, right? So, I mean, who cares that I have expertise in tax rules if nobody has to follow the rules anyway, right? So from that perspective, I think, I've always been in favor of enforcement on the rules. It doesn't. Why play a game where the rules aren't really enforced anyway? But yeah, I'm torn as to whether it's actually a good financial investment to invest in enforcement, particularly when we obviously have this policy to not measure it. So that's it for me on that.
Yeah, no, I'm not sure I have anything else to add on top of that, but yeah, no, I mean, I think it's interesting and I hope that they, keep it in check. I guess I would say, I hope that, we don't award bad acting agents, I guess I would say.
Right.
All right, everybody, that's going to do it for us. Thanks for watching the None of Our Businesses YouTube show and podcast, where we discuss business updates from an accountant's perspective. Also, please check out our sister podcast, Profitless on Purpose, where they're talking anything and everything relating to the nonprofit space. Thanks for watching. Thanks for listening. See you again next week.
Bye, everyone.